Perfect. We'll get this thing recorded. All right. Hey guys, I'm Chris Smith with the Smith Group at MortgageOne. I wanted to do a webinar today on, I'm getting a lot of questions right now in regards to down payment assistance programs. As a company, we had the privilege of partnering with a new fund that is providing a DPA or down payment assistance program. They're calling it Empowered DPA, and that's essentially what we're going to be talking about today. What I kind of going back into my history, for those that don't know me, I'm going to give a brief little background about me personally. I've been a loan officer for not quite 15 years, been doing this a long time, and down payment assistance programs haven't always been the most attractive. The last couple of years, though, we started to see a lot more interest in regards to investors, banks, portfolio loan lenders wanting to be in that space because especially here in California, on the coast, on areas with high income, we have a lot of people that make great income. They just don't save very well. And so there's a lot of potential buyers that could easily afford a monthly payment because they've got high rents that they're easily able to afford. They're just not able to come up with the down payment required in order to get in home. So that space is being serviced quite a lot better than it has been in the past. Now, this program is not the only program out there. This is just a new one, and it's actually opening the door. If we find, that this program may or may not work for everybody, there are other programs that a conversation that this starts could potentially lead to a different program of different down payments. So, but this is a good conversation starter for those that are realtors here. This is just one of those products that's rare that you can talk about with your clients or reach out to past clients. It just gives you something to talk about. For those that are on this call or that are watching this that are potential home buyers, this kind of gives you a starting point. We can have a conversation, dive into your details, and maybe there's something that's more appropriate or this might work. So that's kind of the purpose of this today. So I'm going to go over here. I'm going to do a screen share. Just give me 1 second. Hey, Lauren, you're going to have to allow me to do my screen share, please. Perfect. Can everybody see my screen here? So it's Empowered DPA.
No, not yet.
Not yet. Okay. Thank you, Chelsea.
Welcome.
There we go. Now you should be able to. Chelsea, we good?
Yep, it's loading.
Perfect. Hi, Chelsea.
Hello.
All right. So Empowered DPA. So this is it's a national grant program. And again, I'm not one of those guys that likes to read these slides. We'll go through this, and this is definitely a conversation. So please feel free to interrupt if there's questions. Occasionally, I'll say, hey, let's table that question for later on because it'll fit more within the conversation. But definitely a Q&A as we go through this and talk. So I want to keep this to probably 10 to 15 minutes max. And if we go a little longer than that's fine. Just want to be respectful of your time. So this program is a grant program provided with between a 2.5% to 3% down payment towards an FHA loan, Federal Housing Authority. So this is a normal FHA loan where you're getting that grant. Now, what's interesting about this program is that the grant that they give you doesn't have to be repaid. Okay, it's a completely forgivable loan. Okay, now they'll give you either a 2% down payment grant or a 3.5% down payment. And that effectively goes directly towards what interest rate they provide. And I'll go over rates on this program in a little while. But as you know, as a lot of you know, and those that don't know, an FHA loan requires minimum 3.5% down. So if you do, if a buyer ends up going with the lower interest rate and then decides to bring in the remaining amount, they can do that. So it's one or the other. Now, what I like about this program too is that we can actually combine that down payment with up to 6% of a seller concession. So what this means right here is that the third bullet point here is that a buyer, if they decide to want to buy a home and they want to get a full 3.5% gift, we could negotiate to get a small seller credit on the back end from the seller and wrap in all their closing costs into the purchase. What that effectively means is that it's a possibility where that buyer could literally buy a home with less money than it takes to rent, because there's no down payment requirement. There would be legitimately everything wrapped into that purchase price. Okay, so the down payment along with the remaining 2.5% towards closing costs and such. So it's a really great way for somebody that makes good income but just doesn't have any savings in order to cover down payment or closing costs to buy a home. Also, there's no resale restrictions. So what that effectively means is that we can refinance them after they made their 6 payments and get them down to wherever market conditions are. If they've greatly improved, or if they haven't improved all that much, we can still refinance them after 6 payments, and there's no prepayment penalties on this program. Okay. Oh, it's not available in Washington. That's the only state. All right. Qualifying, guys, 620 qualification factors. And they just need to be DU approved, desktop underwriter, typical. This is typical on any type of FHA loan. The 620 minimum FICO is a little higher than what a regular FHA will allow. We can go down into the 500s on just a non-DPA program through FHA, but this one does require that one, which is still a very low threshold and allows for a lot of buyers to get into the market. Now, the parameters, they allow only purchases. So this cannot be done with the refinance. So they're not going to give you a gift for a refi. Obviously, that doesn't make any sense. They do allow actually quite high of a debt to income ratio, 48.99%. For those that don't know, conventional loans have a lower threshold for qualifying than FHA. And even this program where they're getting a gift, they have a higher qualifying ratio from a debt to income. Again, a debt to income stands for is the amount of debt you have on a monthly basis that's tied to your social security number. And so when you have, let's say you're making 10 grand a month and you have $5,000 worth of debt, your debt to income ratio would be 50%. So that's what a DTI. So on that same analogy, 10 grand a month of income, in order to qualify, all of your debts, including the new mortgage payment, would need to be below $4,899 a month. So that's what DTI. They do allow it for manufactured homes, single wide, multi-wide, condos, but they all have to be FHA approved. PUDs, obviously single family homes, and they actually will allow for a 2-unit residence as well. So if somebody wanted to buy a duplex, not a 3 or 4 unit, but a 2 unit, they could actually use this program to do so, which is really cool. Now, this is actually pretty cool too. FHA has several different sub programs that allow for like a FHA 203 to 203K repairs. They allow for things to be upgraded and repaired before that buyer takes possession of the property, and wrapping that into a purchase price. That's a full process. That's for a different webinar, but they will allow for that type of loan with this DPA program, which is cool. So that really does open up all FHA options. But it cannot be used in conjunction with any other DPA program that's not part of this. And the one thing that here in Orange County, for example, because we're here in California, we have much higher purchase prices. This program is a national program. The current county loan limit nationally is $726,000 and I think $200, but I just call it $726,000 and change. Anything over that in most counties nationwide, then it becomes a jumbo. Here in Orange County, and along with many other counties along the coasts and other places throughout the country, there's a unique middle tier called high balance. The high balance loans here in Orange County go from $727,000 roughly to all the way up to $1,089,000. That high balance, which is a Fannie Freddie non-jumbo, that purchase tier is or that loan tier is ineligible for this program as of now. There's talk that will change, but for now, based on where rates are and the current market conditions, that the loan amount needs to be below 726,000 to do this program. It doesn't matter what your purchase price is, the loan amount just needs to be below 726. Okay. Any questions on that one? That one seems to be a one that brings up questions occasionally. Stop me if there is. Okay. All right, borrower eligibility. This is my favorite thing. I really feel like this investor that created this fund and this grant program is really trying to get anybody they can to be able to do this program. So it's not really exclusively for a specific group of people. Who they are. So first-time home buyers. So if you've not owned a home, we'll go with that individually. First-time home buyer, a current retired employment or volunteer non-paid person. There's going to be an income threshold and then an undeserved census tract. And I'm going to go through these individually and explain what that means. But those are the 4 tiers of qualifying, and you just have to qualify for just one of them. So let's talk about first-time home buyers. Okay, first-time home buyers defined as anybody that hasn't owned a home in the last 3 years. So even if in 2008 you owned a whole plethora of stated income homes that you went bankrupt and everything went to crap for you, you're still now a first-time home buyer. As long as you haven't owned real estate in the last 36 months, you haven't been on title on a home, you qualify. Now, one thing I really like about this too is I actually have a client right now that's doing this program. She was just recently divorced. Her ex-husband and her have had mortgages over the course of their marriage. She just got divorced. She wants to buy a home, but she just didn't have any savings because of all the legal stuff. She qualifies for this program, even though she they recently sold their home that they lived in, because now she is a single person, single family homeowner or homemaker that used to be on title with her ex-husband or ex-spouse, but she is still considered a first-time home buyer, which is pretty unique. I like that. They need to be this property can't be an investment property. It needs to be their subject. They need to be living in the property and have and be taking possession of that property within 90 days. All right, this is the one that I feel is like the most liberal, meaning like it's very flexible. When I say liberal, very flexible of what they're of trying to get people qualified for this program. Okay, so if you've ever served in the military, you're good. If you've ever served as a first responder, a police, fire, public safety officer, paramedic, EMT, anything along that lines, come to us. We can get it. We can get it essentially pre-approved or checked off. If it's a different type of person, but that kind of gives an all-encompassing idea. Okay, this is the number third one is an educator. I like how they have Sunday school teacher here, daycare provider, a tutor. I mean, literally, if we joke on this in some of my calls with some of my real estate partners, hey, I've taught Sunday school occasionally. A couple of years ago, I'll substitute. I can qualify, and so the medical personnel, nurse, doctors, and anything medical related, and then obviously civil servants, federal, state, or local municipalities. So legitimately, this kind of encompasses a lot of people. That educator component. I mean, if you're a mortgage person and you offer lunch and learns and you're educating other realtors or lenders on your business, that's considered an educator. So I could qualify for this program just based on that, if that makes sense. So this is a really, really great program to find individuals, and we can go through and try to figure out a way for somebody to qualify usually. So, all right, income. So the first time home buyer is number one. Number two is going to be income. So what they will allow, so a buyer that has an income that's at least less than or equal to a 140% of the state or county median income, regardless of family size. Everybody that's on this call, and we're going to also have a link that takes you to this, will have access to this median tool here. But let me click on it for the sake of so you guys can see what this looks like. Okay, so this is the Fannie Mae area median income lookup tool. You can actually Google this, and it'll come right up. Just look up, type in Fannie Mae lookup tool, and it'll come up on Google. Let's put a zip code here in Orange County, here in Mission Viejo 92691, which is Mission Viejo. And it looks like the area median income is $105,200. So hold on one second. Okay, so the 105,200, we just need to be 140% of that times 140. Oops, sorry, 0.10, I meant to put, I forgot that one. So 105,200 times 0.140 equals 100. It'd be 147,280. I'm really bad at math, guys. That's why I use calculators. But 140% would be 105,200 times 1.40. So that would give you 147,000. Everybody always laughs at me because I have to do it 3 times to get it right. 147,280. So anybody who has an income of equal to or less than that would qualify based on this one if they were buying a home in the Mission Viejo area. Now, this will probably hold true of most of Orange County, but you would just want to type in a potential address of a property to see where that median income threshold would be. That's how you would look up using this as the qualifying factor of whether they would qualify, if that makes sense, guys. Any questions on that? Okay, perfect. So that's what that's the second qualifying factor. All right, so the last one is going to be underserved census tract. So this essentially is very difficult to find any of these type of areas in places along the coast. But this would be in areas where there is, here, I'll give you the second. There was a list of 3 things that were second. Okay, so underserved census tract, this would be areas where the average income is 80, or sorry, someone's income is 80% less than the median income. They are the median income, less than the median income resides in the minority tract area, okay? And then the median income is less than the average residence within the disaster area. So there is again, this is kind of a confusing one, to be honest with you. I've gone through and read all the guidelines. This is going to be one where a home buyer is wanting to look to buy in rural areas throughout the country. This might be a program that one of the qualifying factors that would be good for those areas. We just don't have them. Orange County is actually off the list of an underserved census tract area. Again, when I looked it up, it was one of the areas that just hasn't been designated that one. So if there are any clients outside of the OC area, San Diego, LA, outside those areas, come to us and we can look up and see if that's a potential home buyer would be, and those areas would be qualifying for this program. So that'll be a kind of a unique one that we could look at case by case. Again, the program itself is not available in Washington State, which again doesn't really affect us here. And Wisconsin has a few things that we need, but okay. What are some of the additional things required in order to do this program? I'm going to be really fast on this one. There's just 3 additional documents. Here's, as realtors or clients, the difference on this program versus any other type of loan in FHA or an FHA loan is literally going to be the same process. Loan estimates, income documentation. So we're going to require pay stubs, W-2s, all the normal income documentation. We pull a credit report, we do a loan application. So on top of those, there's only 3 additional documents needed in order to do this program. And those have to be wet signed. So we can't do those like a or an electronic signature type of thing like DocuSign. And so that's what this program is. But when we're in the program, we'll get those over to you. There is a home buyer education requirement to do this program. Again, skipping through this very quickly, just know that when you do talk to clients or you are looking at this program yourself, there is a pre-purchase home buyer education workshop or counseling that's required. It's very easy. We've had clients do it. It takes no time at all. And that's something that we would be able to facilitate helping you get signed up for it. So, all right. We had talked about the median 140% in median income. So we're good there. We don't need this is for lending purposes on how we need to do it. Just give me a second, go through this. All right. So the fees on this program, there's a $100 counseling fee that we just talked about, the education, closing costs, and would be wrapped into a purchase price up to we can go up to 6% of the actual loan amount, include 3.5% for down payment, and then 2.5% remaining towards closing costs. Your closing costs, as you know, as realtors, and then those that have purchased homes in the past, your closing costs are all the transactional fees associated with this. And those are going to be the same whether you're doing this program or not. Okay. So there's no difference between this program and any other program. Okay. There's not a special appraisal cost. There's not a special, DPA fee or anything like that. It's literally everything's normally the same. The one that's different though is going to be, I'm going to go over here. Let me pull this up real quick. Okay, so I did I reached out to our investor to see where rates are today. So if we were to do this program, the rate on this program would be slightly higher than where market is on average right now. So the market conditions for FHA are in the mid sixes for the purpose of this lesson that we're looking through today. If you're watching this at a later time, this is going to be very dramatically different depending on what happens to the market over the next few weeks and months. So don't hang your hat on this information, being this, we're right in the middle of June 2023. So reach out to us and find out where rates are on this program at any given time, because they are adjusting based on market conditions. But if, for example, we were talking to a buyer today, they were interested in getting their gift of 3.5% down, the rate would be at 7.75%. So it's a little over 1% higher than on average where the market is today. Okay. Now this is important because the benefit of doing this loan is a couple of things like we've talked about. Number one is that they're getting a gift of 3.5% that they're not having to come up with on their own. Now, looking at 3.5% gift, if we look at that from on a calculator, let me close this out real quick. So let's say that we're doing a maximum loan amount of the 726 times 0.035. They're looking at, hey, look, I did it the first time right. $25,410 gift. So that's free money that's given to that buyer that doesn't have to be repaid and legitimately goes right into their equity, essentially their pocket through the equity of the home, right? So it's a really huge amount of money. And the idea is that the buyer would take a slightly higher rate. That's why this grant is able to give this gift, is that grant is able to make money on the backside to make up for that 3.5%. That's how the program works. But that $25,000 gift, let's say, for example, that home buyer decides to, we have to make 6 payments before they refinance. But let's say, for example, but first of all, let me go back a little bit. The difference between where market conditions are today and where this program is about a $550 a month difference in payment. It's a big amount of money. But let's say that they decide to take the higher amount of cash in the form of the gift on the front end in lieu of having a slightly higher rate. Let's say that it's a year before we're able to refinance them, okay? Over the course of that year, that payment, let's say it's 12 months before we fund the new refi. That means for $550 times 12, they're gonna basically use $6,600 of that equity in the form of having a higher monthly payment. Does that make sense? So over the course of 12 months, they took a lump sum gift on the front end towards their down payment. But because we're not refinancing for a year, let's again just using that as an example for easy math, they're gonna use up $6,600. Now that, again, I'm just rounding to 25,400 minus 6,600. Their positive cash flow just on the gift of $18,800. So they literally made almost 19 grand on this transaction, having refinancing 1 year down the road that they didn't have on the front end. On top of that, all the appreciation of that property. So the motivation of somebody taking advantage of this now versus waiting a year to save up on a down payment is 2 things. 18,000, almost 19 grand of free money to take a higher payment for now. And number 2, the ability to have the appreciation on that property coming back to them in the long run whenever they sell their home or just owning that real estate. So this is a great way. This program is a great entry tool for somebody that's like, oh, I got to wait till I come up with a down payment. Like, don't do that. Well, the rates are too high. I can get a better rate now somewhere else. But no, but you're giving up on the opportunity to capture a significant amount of income, appreciation, and also this free money that's in the form of a gift. Guys, does that make sense? That conversation of how that would look, even having a higher rate in this case makes a lot of sense. Okay. Now, let's say it's 6 months down the road. So they have to make 6 payments in 210 days from the note date. So it's about 6 to 8 months down the road. If rates have dropped, we can even do it. We can refinance then. And again, that, depending on where rates are in that time frame, we may be able to make up what they lost within that 6 to 8 months really quickly, depending on how much their monthly payment drops, right? So again, it's all just based on setting the expectation and really gauging the risk of that homeowner, how long they're willing to take the risk of rates not coming down. So that's a conversation that I have every day. Okay. All right. What are some questions that I've been asked on this? I put them here. So one, will the program allow for a non-occupant co-borrower? Yes. So FHA allows for this. So they're just following FHA guidelines. So let's say I'm buying this with my sister. She lives in Arkansas, but I don't make any money and she qualifies with her income. As long as one of us has, and this is question number 2, do all borrowers need to meet the requirements for this program? No, only I do. If my sister owns a property there in Arkansas, but she wants to help me qualify, I've never owned a home in the last 3 years. She can be on the loan with me because I qualify for the program. Only one of us needs to do it. Okay. From an underwriting standpoint, a lot of people on this call and watching this at a later time know that my branch and my company, we like to underwrite our files and have them fully underwritten before, as part of the pre-approval process. We call it TBD underwriting approval. The investors on this program don't do that there, but we as a mortgage company do TBD underwrite on all FHA loans. And so we would be able to fully income and credit qualify that buyer. We would also be able to send over and get an approval on whether that person qualifies for one of the 4 requirements. So it says that it is not permitted for them at the investor, but we can do it here in-house. So, which is really nice. If you've previously had home counseling, does it count? It does, as long as the expiration on that counseling doesn't expire before the note date on the purchase. So that's something we'll take a look at. Just one person needs to do the credit counseling, no matter how many people are on the loan. Oh, this is one thing I really love. On this program, guys, you don't have to only do 3.5% down. Let's say a buyer actually has been saving money and has, let's call it 10% down. This is still a great conversation to have with those potential clients. And if you yourself have saved money, to combine it with this loan, because that 3.5%, if you feel like rates are going to come down in the short term, let's say within the next year to 2 years, and there's going to be an opportunity to refinance, there's a conversation that this still makes sense to have a slightly higher rate, as long as you qualify or are comfortable with that payment, knowing that you're going to walk away with more cash left on the table that's left over that hasn't been earned in the form of, it hasn't been lost in the form of a higher monthly payment. So we had a client not long ago that had a 10% down payment. They wanted the 3.5% additional free money. So they totaled 13.5% down payment, did an FHA loan. And we're going to be refinancing them, when rates come down here in the next couple of months. Actually, there's 6 payments due here shortly. So once that happens, we will be able to refinance them into a lower rate. And they literally walked away with percentage, a little about 2.5 to almost 3% left over that they didn't earn or didn't use up in the form of a higher payment. So they end up walking away with significant more equity than they would have had they just brought in their own 10% and took a lower rate from the beginning. Does that make sense? So taking the higher rate to get more free money, depending on how long that timeline is before you refi, may or may not make sense. So we want to just analyze that individually, case by case. We already talked about the additional disclosures. We talked about the 140%, and the funds will be distributed at closing per the buyer instructions. So, guys, any questions on that? That's the full program. Stop sharing.
Hey, Chris, there's a couple questions in the chat box for you.
Oh, thank you. Couldn't see those. Thank you. I appreciate that. Okay, yes, I will share the slide deck at the end of the presentation. Hi, Grant. 2.5% of the purchase price. Good question. Or sorry, 3.5% of the purchase price. So hypothetically speaking, if a buyer, if somebody wanting to buy a home didn't have any down payment, but they did qualify for the very maximum loan amount. So 726,200 divided by 0.965. So they could buy a home for $752,538. That would be the maximum purchase price in order to get a full 3.5% down payment without any of their own down payment added to that, if that makes sense. So this is essentially what the purchase price would be, and then the down payment 3.5% would put their loan at 726,000. Does that make sense, guys and girls? Cool. Grant, did that answer your question? Assuming so, yes. Cool. Any other questions, you guys? I'm really excited about this program. I think we've done it. We've talked about it with a lot of clients. Hopefully we'll be able to open up some high balance loans as well on this program as rates kind of improve a little bit. But yeah, I think this is a good starter program. This would be good in places here in Orange County for first-time home buyers. There are condos, maybe 1 or 2 bedroom homes, that type of purchase range. So it's really good for starter homes and condominiums and places like that, or maybe towards Riverside or areas where it's a little bit lower cost. Cool. And again, this is a great conversation starter to be had. So I'm going to provide this. I'll provide this to you guys. So you have these slides. This would be a good thing to send out to all past clients, all current clients, and just say, hey, here's a great program. I'll also include in that email that goes out a really short synopsis of what the slide is in the program so that it's easy to share. And that way you guys can utilize this. Call us if you have any questions. All my contact information is here. I'll be in my email as well. And yeah, any last questions before we close out here? Nope. I appreciate you guys. Happy Thursday. Can't believe it's already mid-June in this crazy year. It's gone by so fast.
Hey, Chris, thanks for always bringing value, man. I appreciate you.
Of course. Thank you, Scott. Appreciate that.
Fantastic program. That's really incredible. Great presentation on it. Thank you.
Cool. Thank you, Todd. Appreciate that, man. Nice to meet you.
Nice to meet you too. Let's connect. I got your info.
Cool. Sounds good. All right, everybody. Thanks so
Bye, guys.
much.